Good morning, good afternoon, good evening. My name's Dipesh Patel, editor at Trade Finance Global and host of Trade Finance Talks. Welcome to our listeners and thank you for joining us from all around the world. Today we're live streaming a very special Tradecast, broadcasting on LinkedIn, Facebook, YouTube and TFG's platform. Today, we're talking about CPRI or non-payment insurance, performance-based or surety, and export credit insurance. And yes, I'm about to tell you why there's an umbrella in the background. The media often shirk trade credit insurance as an umbrella that doesn't open when it rains. But to what extent is this actually true, and how has the product fared during recent times? In a world where roughly 15% of trade is protected by credit insurance, which really does help increase lending capacity, provide regulatory capital risk, manage concentration risk and country limits, eyes are often on the trade credit insurance stage. Managing commercial and geopolitical risk in trade transactions has been paramount recently. We've seen the pandemic shut shop on businesses around the world, the humanitarian and economic ripples of the Russia-Ukraine war, and mounting inflationary pressures. Trade Finance Global are hosting this Tradecast today, kindly sponsored by Tinubu, to delve deeper into the realities of today's climate. Therefore, I'd like to welcome to the stage Gary Lowe, Global Head of the Global Credit Insurance Group at Standard Chartered, Jerome Peze, CEO at Tinubu, Janusz Wladacek, CEO at KUKE, the Polish ECA, and Richard Wolff, Executive Director at ICESA. Welcome to this Tradecast. So, introductions. In no more than 30 seconds or so, I'd like you to all give a quick elevator pitch. Who are you? Where are you from? And what do you do? Gary, I'll start with you.
Great to be here, Deepesh. My name is Gary Lowe. I'm the MD and Global Head of the Global Credit Insurance Group at Standard Chartered Bank, which means that my team and I are responsible for all of the non-payment insurance and some political risk insurance that we purchase across the bank. And we use that to manage exposures, capital and returns.
Thank you very much. Jerome, over to you.
Yes, good morning. So after decades of being an underwriter and working in trade finance, I co-founded 21 years ago Tinubu Square, which is a leading company providing a solution to digitalize credit insurers and surety players.
Thank you very much. Janusz, over to you.
Good morning, everyone. My name is Janusz Wladacek. I'm a CEO of a Polish credit agency. So trying to support Polish exporters all around the world and trying to be involved in many projects which are happening at the moment and trying to develop the ECA business altogether with other market players.
Thank you very much. And Richard, last but not least, over to you.
Good day. Dipesh, thanks for having me. It's lovely to be here. I'm Richard Wolff. I head up the International Credit Insurance and Surety Association, and it is what it says on the tin. We are an association of largely private trade credit insurers, surety, and their reinsurers. We advocate for our members, and we try to spread best practice.
Thank you very much. What an excellent panel we have here from all around the world, from Poland, France, Holland, Singapore, and London. Let's start with a bit of a helicopter view of trade credit insurance, and just to break it down to our listeners, Gary, perhaps can you give us a short overview and synopsis of what trade credit insurance actually is and what it encompasses? Perhaps talking about the difference between public and private, short term, long term, and how it really underpins global trade.
Well, I mean, there are multiple parts to this industry, and the piece that I specifically focus on is around non-payment insurance, which is a tool to protect lenders, but also traders and corporates against non-payment of a debt by a borrower or by a buyer or an obligor. And therefore it sits within our overall distribution strategy. I sit in a platform within the bank which looks to optimize capital, manage risk, enhance returns, but perhaps most importantly of all, support our clients by doing more. So like any prudent lender, we have overall risk appetite on a particular obligor, group, sector, country. And we do business that we like doing, but in order to do more of it, that there need to be tools to manage that overall risk, and that's where we use the product. We use it in multiple billions per year. We have multiple billions exposed at any point in time, and it's, as I say, it's an important part of our overall syndication and distribution strategy. But if you look at the different strands of it, so my piece is around this kind of medium-term non-payment insurance. The terminology is a little bit interchangeable, but that's what we call it. Some people call it CPRI or structured credit. It's the same thing. And then trade credit insurance is the original and by far the larger piece of this world, which is equally well used by banks and by corporate sellers of goods, facilitating cross-border trade across the world. Again, it might be with clients and with buyers you have a perfectly good relationship with, but need to manage overall risk exposures, or it could be, you know, getting into frontier markets and supporting credit risk in a way that really is around risk management more than only aggregations. And then of course there's the surety piece of this, which is more around performance protection. And then of course, you know, probably the most famous, and I'm sure Janusz is going to tell us the most important part of it, the multilaterals, agencies, and public sector bodies who are really about promoting originally national interest in terms of exports, but increasingly you know, supply of goods, flow, services, but also, you know, ESG objectives where you know, governments have a development interest around ensuring that the trade, project finance, infrastructure development is happening in a way which is bankable, and therefore, you know, credit risk is protected. So that's the kind of world of credit insurance overall. Different strands of it attract different market participants, public and private, and attract different buyers, you know, corporates, traders, and banks. And I think, you know, sometimes they are quite separate, but broadly speaking, we're all trying to do the right thing here, you know, which is manage exposures, manage capital, manage returns, and facilitate global trade and investment.
Thank you very much. I'm very impressed you managed to give that overview in just under 2 minutes, you know, talking about CPRI and non-payment trade credit insurance, surety, and the ECA side of that. And for sure we'll move to Janusz in just a second. But actually, Richard, I'd like to ask you, and also within the context of the umbrella that doesn't open according to some media outlets, why do you think that was portrayed, and also can you talk about why banks utilize trade credit insurance?
Why banks utilize trade credit insurance is very similar to what Gary just said. Speaking with our members and looking at industry research, we basically see 5 reasons why banks utilize the product. And that's first, to increase lending capacity while complying with internal credit limits. And that's what Gary said, helping clients, helping to do more. The second really important one is regulatory capital relief. If we can make the whole process just a little bit cheaper and just a little bit more smooth by saving capital of the clients of our members, the financial institutions, I think we've done a pretty good job, and that's why clients buy. You can also think of concentration risk management to specific industries, to specific events, for instance, and something Gary mentioned, increased return on capital. Yes, it is important. If our capital for a specific risk is cheaper than the one of the financial institution we serve, we've done a good job. And last but not least, country limit relief. Some financial institutions are full on countries. They turn to us and say, can you take some country risk off our hands? Now, this applies to basically all asset classes that banks place. Now, my members generally cover the risks stemming from non-payment of trade finance. So, meaning receivables meaning payment undertakings and LCs, and also supply chain finance. Now, talking about the umbrella that doesn't open, the product works. And I think the best proof of that is that the loss ratio hovers around 50%, with $346 billion in transaction facilitated for banks. Of all the claims that we've received in the time period between 2007 and 2020, 96.8% of all claims were paid. And factoring companies will easily fourth times that amount. So this umbrella opens the page.
Thank you very much. And I guess, Janusz, if the umbrella does open, and what's the purpose of an ECA in terms of providing that public support? Is it when the private market stops?
It really depends. I think nowadays we have an issue that we've for already a couple of years. We're seeing loads of turmoil going on around the world. So in fact, trying to be involved in long and medium term transactions, it is hard not to use the umbrella of ECAs or other multilateral type of institutions. If we are talking about the short-term business, then maybe it's not an issue because we can always find the solutions, especially if we are talking about trade, which will be happening in so-called developed world. Whereas we've got loads of commercial type of players on the market. Whereas if we go towards developed or developing countries, but in a slightly different tenor perspective, and what we are observing even in countries which we've in the history we perceived them as quite safe, nowadays you cannot be really sure if they're still in the same situation. With all those turmoils going on, I think all the market players, not only investors, but financial institutions, all of those need someone who is going to support them. And I think ECAs are playing much more crucial role than they used to. I think the whole industry went through, especially through COVID times, it went through plenty of changes. So in fact, we're not only those who are eager to be involved in transactions in countries which are more risky, but at the same time, we've been employed during COVID times in many countries to help domestic economies, to help not only exporters, but to help companies. So in fact, our role has changed a lot. And we are not only those who are in fact, at the end of the day, supporting or helping to do the transaction, but at the same time, we try to facilitate the trade. So we are those who are playing the role of middlemen who is searching for projects with investors, with financial institutions, with banks, and together with them, then we are trying to find companies who are eager to perform those projects. And for instance, we're trying to facilitate trade on the global scale, looking for suppliers. So the role of an ECA, it's not the pure role as we had in the past.